here now, Thru The Cycle president, John Lonski. John, great to see you. Everyone was excited about this 2.6% number, but once you really broke it down, you saw a lot of it had to do with government spending. A lot of it had to do with exports. And when you take it, on the whole, with the negative quarters of GDP growth, it's only a 0.4% reading, really, which is anemic growth at best. And so you have to stand back and look at this and say, why is the president cheering?
Yeah, just for the third quarter itself, we find if you take out this non-recurring, extraordinary narrowing of the trade deficit that was a consequence of a one-time 14% jump by exports along with a 7% reduction by imports. That's not happening again. If you take out the trade deficit, that change in real GDP goes from plus 2.6% to minus 0.2%. So the good news owes everything to this one-time narrowing of the trade deficit. It's not going to happen in the future. Fourth quarter will be doing well if we get growth of 1%.
Right. And here's how I look at it. I stand back and say, there's still not as many people working as there were pre-pandemic. Real wages are negative right now. We still have inflation at a 40-year high, so people continue to shell out hard-earned dollars for goods and services, and that's putting pressure on them. You've got BlackRock saying that the Fed is likely to hike rates 3 times, two more opportunities this year, but then into next year as well. That says to me there's more pain ahead.
There is more pain ahead. My goodness, Fed funds, you're speaking about that, is only 3.1% now. Chances are it ends the year at 4.4%. And BlackRock, they're suggesting
the Fed 4 3/4.
Yeah, it might be 4 3/4, 4.8%. Remember, not too long ago, that was 0%. That's one heck of an increase by short-term lending rates over a relatively short period of time. Can the U.S. economy shoulder that without suffering? No. If we continue to have that 10-year yield hanging around 4%, if we see short-term rates going up this steeply, we are going to have quite a slowdown in the U.S. economy. We already have an interest rate-inspired recession in housing that might yet degenerate into outright home price deflation. And this warns us of rough times ahead in 2023.
Yeah, and we talked about that last night. Mortgage rates topping 7%. That's squeezing a lot of people out of the market. But John, I want to look at the market today. For example, Dow is up 163 points. We've been on a little bit of a winning stretch here. Market watchers are saying that the market is moving higher on optimism out of earnings. There have been some good reports. There have also been some bad reports. There have also been reports and management companies that are coming out and being very cautious on guidance. Amazon is one of them. As a matter of fact, on their call, Amazon said that they're a little cautious on hiring.
Yeah, Meta or Facebook's had a lot of problems, too. It had a horrible day in the equity market. I think it was down by nearly 25%, according to my latest read. And we're going to have problems with corporate profitability next year. Existing estimates are perhaps going to prove to be too high. What you mentioned earlier, Jackie, is spot on, and that is the fact that we've had inflation, prices growing more rapidly than wages for too long, and that is eventually going to catch up with real consumer spending. I expect a lackluster holiday shopping season with perhaps consumer spending taking a turn for the worse during the early part of 2023. Getting back to housing, we have recently, October to date, we're looking at like a deeper than 40% year-to-year decline by mortgage applications from potential home buyers, and that's much deeper than September's 23% year-to-year decline by unit sales of new and existing homes, and that's warning us that home sales have yet to bottom, that we're going to do even worse on that front. Bad news for sales of appliances, of furniture, and building materials.
Well, I think you make a lot of sense the way you break it down, yet the president says everything's great. So people are going to have to parse through those words and figure it out for themselves. John, great to see you.
Okay, thank you, Jack.
Thanks for joining us.